In this video, we will discuss a history of monetary policy and inflation. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I currently work as a portfolio advisor and a retirement strategist, and also as an adjunct professor of accounting and financial management for the University of Maryland's Global Campus. This presentation is a slightly edited and updated version of a presentation given to the Greater Ozark Pachyderms in Springfield, Missouri on April 9th of 2021. While I currently primarily managing money, in the past I've had a variety of academic positions. I was a chair of accounting and financial management for the University of Maryland's Global Campus. I was also a chair of the Division of Business Administration at the Rochester Institute of Technology's Dubai campus. I've been a program director at Park University and held a similar position at Northeastern State University. And before being in finance, I was in physics and held research positions at Los Alamos National Laboratory and the University of Missouri's Research Reactor in Columbia, Missouri. Today we will be talking about monetary policy. Monetary policy has varied quite a bit throughout history, but historically the most important system of monetary policy was using a base metal standard. So throughout history, including going back to Greece, Rome, and the Middle Ages, the primary system of using money was gold, silver, bronze, and other types of metals. If we go recently to the United States, during a large fraction of our history, we were also on a metal standard. At the beginning of the United States, in the late 1700s, the U.S. primarily used gold and silver coins that were not made by a U.S. mint, but instead were circulated from a Spanish or other mint. With the advent of the United States, they started minting their own silver coins and copper coins, which you can still buy today if you are a coin collector. And throughout most of the U.S. history, we did not, until after 1913, have a central banking system. There was a central bank at the beginning of the United States. This was one of the major arguments between Alexander Hamilton and Thomas Jefferson. Thomas Jefferson was against the First National Bank, whereas Alexander Hamilton was for it. George Washington backed Alexander Hamilton. They had worked together during the Revolutionary War, and the First National Bank was created. Jefferson would have liked to get rid of this bank, but it was not up for charter when he was president. It was abolished under the presidency of James Madison. Soon after that, the U.S. was embroiled in the War of 1812, and Madison decided it was a good idea to recreate a bank, the Second National Bank, to pay soldiers after the White House had been burned, and this is a common way of governments paying their military. This graph here is the general price level from 1800s till close to today, and you can see it's largely flat until after World War II, but there are some bumps back here when the prices went up, which we would call inflation. One of those was during the time period of the Second National Bank in the War of 1812. This bank lasted until Andrew Jackson became president. Andrew Jackson hated the bank and abolished it. Nicholas Biddle, the head of the bank, said he would destroy Andrew Jackson and blame the economy on him as he made it high inflation and having lots of problems, but Andrew Jackson was able to win out over Nicholas Biddle. In fact, the Second National Bank was eliminated, and we had no central banking until the Fed was created in 1913. The first and second national banks are still visible buildings, and you can tour them if you visit Philadelphia. There was paper money, briefly again during the Civil War, called greenbacks that Lincoln printed to finance the war. He also tried the first income tax in the United States. The income tax was declared unconstitutional, and the greenbacks were retired after the war. So the U.S. largely was inflation-free until after the creation of the Fed in 1913. When the Fed was created in 1913 by Woodrow Wilson, same person responsible for recreating the income tax, it did what central banks tend to always do. It printed tons of money. Now, under the initial creation of the Fed, it was only supposed to print enough money that it had gold to back. It clearly printed way more money than it had gold to back. And this created the stock market bubble in the 1920s, and also then in 1913 or 1933, after the stock market crashed, largely from the Fed cutting down on its money printing, it also resulted in FDR taking the U.S. off the gold standard, basically defaulting on the backing of the U.S. currency with gold. And he went one step further. He made it illegal for American citizens to own gold and confiscated all of the gold in the U.S. banks and created the bullion depository at Fort Knox to put it in. Technically, individual Americans were allowed to own around 5 gold coins, although many of them were pressured to turn them in, and all of the banking gold was seized. So this took the U.S. citizens off the gold standard, and it stayed that way until Nixon defaulted on an international gold standard in '71, which was called the Bretton Woods Agreement. And from '33 to '71, it was illegal for Americans to own substantial portions of gold coins or bullion. They could own gold jewelry. So after World War II, the victors got together and created a sort of a gold standard at the Bretton Woods Agreement, but this was only a gold standard for central banks. They tied all of the world's major currencies together at a fixed rate, so there was a fixed rate of exchange between the pound and the dollar, and the Deutschmark and the dollar, and the yen and the dollar, and then the dollar was supposed to be backed by gold at $35 per ounce. Again, of course, the central bank did not honor this agreement. They printed more currency than they had gold to back it, and they did this to finance the U.S.'s war in Vietnam, Lyndon B. Johnson's Great Society program. And you can see as a result of this, we have increasing inflation. And finally, here around '71, Nixon defaulted on the gold standard, did not honor the Bretton Woods Agreement, particularly against the French. The way the Bretton Woods Agreement was handled is beneath the Federal Reserve Bank in New York City. You can take an elevator down to the bedrock, and there are jail cells filled with gold. So the French kept calling the U.S. on the Bretton Woods Agreement. They would bring in U.S. dollars, and the U.S. would take dollars or take gold out of the U.S. jail cell and stick it into the French jail cell. Eventually, Nixon admitted the U.S. didn't have enough gold to cover its agreement, and they defaulted. And you can see there has been massive inflation since that default in '71. So why did we get off the gold standard? Well, governments like to print money, and it's restriction of that. Also, there are a lot of ideas associated with the communist movement in the late 1800s that would move against things like a gold standard and many other of the founding ideas of the United States. So U.S. originally had no income tax. If we look at the 10 bullet points of the Communist Manifesto, one of them is a heavy progressive or graduated income tax, which was put in by Woodrow Wilson, the same president that put in the central bank. Number 5 here is centralization of credit in the hands of the state, i.e. the Federal Reserve System. Other ones on here that are common today are free education, so you can teach all the children to be good communists. This is a copy of the 1933 executive order by President FDR that took the U.S. off the gold standard and made gold ownership illegal. Note this is done by an executive order. It wasn't even a vote of Congress. So one man was allowed to basically confiscate almost all the gold in the United States. As we mentioned, the Bretton Woods Agreement was put into effect after World War II. It was in effect until '71 when Nixon defaulted on it. Currently, gold is around $2,000 an ounce. It was supposed to stay at $35 an ounce. It clearly did not, and this agreement did not work. So what backs the buck today? Primarily debt. If you're spending $1, then you are spending a portfolio of assets, sort of like a money market fund. As we look back here early on, a large fraction of that money market fund was gold, and you could exchange your dollars for gold. There were other items in here, discounts and acceptance is bought. Today, it's almost all government debt, or during the housing crisis, they even converted from government debt, and for a while, primarily, the debt was backed by things like home mortgages, or the dollar was backed by things like home mortgages. World today is a combination of fixed versus floating rate currencies. The US, obviously, its dollar floats against things like the euro and the Japanese yen, but there are countries like the Middle Eastern countries, like my previous residency in the United Arab Emirates, that fix their currency to the dollar. They largely do this because they have a lot of oil. They sell the oil in dollars, so they're in the petrodollar area. Other countries also fix it against the dollar, and then there's the European bloc. And there are a few countries around here that have simply dollarized. For example, Panama, Ecuador, and Zimbabwe, which we will talk about earlier, just use the US dollar as currency. Panama, it's due to the history of US troops being there a long time, and Zimbabwe did this after their own currency collapsed due to hyperinflation. Here are examples of hyperinflation. This is quite recent, 1600 in Venezuela. They got up to 800% annual inflation. And of course, the government commonly won't admit they have high inflation, so they claimed it was only 200%. The inflation rate was also very high in Russia, as it was in many South American countries in the late 1990s, also reaching around 800%. And here is the Zimbabwe hyperinflation I mentioned. It is the highest recent hyperinflation, at one point having a daily average of 98% per day. Obviously, in this sort of an environment, it is very difficult to do business. If people get paid, they try and get rid of their currency as quickly as possible, buy the groceries they need, fill up their car. If there's anything left over, transfer it to something that might keep value. If possible, dollars, gold coins, expensive rugs. This has worked in many countries. In Argentina, when a lot of people did it, they converted it to dollars, kept them in safety deposit boxes and dollar bank accounts, and the government seized those as well. So it's not always, in fact, it is definitely not very easy to hide from a hyperinflationary currency. One of the most significant hyperinflationary periods in world history, or at least recent world history, would have been under the Weimar Republic, the collapse of which gave rise to Adolf Hitler. So the economy was horrible in 20s Germany, and one of the reasons for that was the massive overprinting of money. Here we show a woman who is taking cash and burning it because it's cheaper than wood. It was used for many things, like I believe also wallpaper, because it was cheaper than wallpaper. And this sort of instability tends to cause governments to collapse, as the Weimar Republic, which was their effort at a democracy between World War I and World War II, collapsed and gave rise to Hitler. Here is an example of the $100 trillion bill, the highest currency ever printed in Zimbabwe. Again, after this collapse, they just went to the US dollars. But these are still of value today. You can buy them on eBay. They're collector's items, and I think they're worth about $100 a piece. I've got a few of them. So what's going on in the United States today? If you go to the grocery store, you see grocery prices are going up, used car prices are skyrocketing, rental car prices are skyrocketing, wood prices are skyrocketing, housing prices are going up, the stock market is going up. What is causing all this? Well, what generally causes inflation is increase in the money supply. So the government right now is printing lots of money. They're paying some of it to people to not work but demand stuff, so things aren't being produced but they are being demanded. And of course, companies can do things like borrow at a very low interest rate and buy back their own stock. People can take the money they're getting in checks and go to places like Robinhood, even if they're very small investors, and buy stock. And people with more money, of course, billionaires, get great advantages from being able to borrow money and buy stock. So largely all the money printing is causing inflation to go up and probably more benefits the wealthy than the poor, since they tend to have money in the stock market. If we look at one measurement of the money supply, the total monetary base from the Federal Reserve site, we can see that it was below $1 trillion before the housing crisis. To bail out the banks during the housing crisis, they made that money supply go up by a factor of 4 to $4 trillion. Gradually, it went down a little bit to a little over 3, and now they have doubled it again up to 6 during the COVID crisis. So all of this money printing by the government is bound to cause inflation. It hasn't caused prices yet to go up by a factor of 6. There are multiple reasons for this. One is all this money doesn't get out into circulation. And of course, a lot of it doesn't go to increase grocery store prices, but instead housing prices and stock prices, which have gone up significantly. And also, since the world is on a dollar basis, the US dollar is the world reserve currency, to some extent, the United States is able to export its inflation. This is a graph of the U.S. Consumer Price Index done by an organization called Shadow Stats, which are economists that try and calculate the way the U.S. used to calculate inflation back before all the alterations were made in the 1980s. So the red line at the bottom is the official CPI. You can see it has popped up above 5% recently, so even the official rates are now back in the heights that they were in the late 80s and briefly right before the housing crisis and largely in the early 80s. The blue line at the top is their estimate of what they would consider the real inflation rate to be, or the inflation rate at least that if the previous methods of calculation were used, which were putting the numbers between 10 and 15%, maybe 13%. So government has a strong incentive for their official inflation rates to be lower than they really are. Before the 1980s, before these changes were made, the Social Security benefit was indexed to inflation, so the higher the inflation rate is, the more money the federal government has to pay out to Social Security recipients. And also tax brackets were indexed to inflation, so the higher the official inflation rate is, the less money the federal government gets in taxes. So if they were to underestimate inflation, it would save them money they don't have to pay to retired people, and it would allow them to tax people at a higher rate. If you go back to the 70s, when there were something like 10 or maybe even 20 tax brackets pre-Reagan, bracket creep was very common, where your salary would go up, but your buying power wouldn't, and you would be pushed into a tax bracket higher than your previous one and pay more taxes, even though you weren't really able to buy any more goods. And this is sort of happening again today. So what kind of changes has the government made to its inflation calculation methods? Well, one of them is the basket of goods method. Since what people consume, the basket of goods in inflation always changes, but now they change it a lot quicker, and they do things that really would change the basket that people would buy based on their ability to no longer afford it, rather than changing desires in the marketplace. For example, right now steak is very expensive and hard to get a hold of, so perhaps a lot of people have switched to hamburger. Well, this may not cause inflation because the government would just say, hey, you've switched to something else, it's really the same. Beyond the basket of good corrections, another correction the government made to the official consumer price index was so-called hedonic corrections. They would say things like, well, if this year a car is more expensive than it used to be, It's not really the same car, it's a nicer, newer car, so the price hasn't gone up. One of the explicit hedonic corrections they made was during a time period that the U.S. required a fuel additive that increased gas prices nationwide by about 10 cents a gallon. They said this was better fuel and therefore gas prices hadn't gone up for inflation reasons. You put all these corrections together, and at least according to shadow stats, you are underestimating inflation in the United States by 5, maybe 7, 8, 9%. So pretty significant changes. By no means is the U.S. or modern governments the only governments that have created inflation. It is far easier today since you don't even have to print paper money, but you can just create electronic money out of nowhere. In ancient times, it was more difficult for governments to do this, but they certainly managed to debase their currencies. This top graph here is the number of grams of silver per coin in one of the Roman silver coins called the denarius. And it was around 4 grams from late BC to early eras of the emperors, and then gradually the emperors started debasing the currency. So they would melt down silver coins from past emperors, they would mix in a base metal, and then they would spend it again, basically claiming it was the previous silver coin. So we go from around 4 grams per denarius, around 60 AD, to close to no silver in the official silver coin around the time period the Roman Empire collapsed. So currency debasement is probably not particularly good over the long run for the stability of governments and countries. So what about the future? World reserve currency status does not last. The U.S. has had it really since maybe around World War I, certainly after World War II. Before that, it was the British. At some point in time before that, it was the Spanish. So the U.S. dollar will probably not be the world reserve currency for at least another 100 years. So what are the possibilities? Well, Bitcoin does have advantages over the dollar. It has a limit in the number of them you can create, so it cannot be highly inflationary. It may be somewhat difficult to engage in transactions, since my understanding is I'm no Bitcoin expert, but it can take 20 minutes or so to complete a transaction, which might work fine for ordering things online, but not for quick exchanges. The old tried and true currency is certainly gold. If you were going to bet in 1,000 years what would still be used, probably gold is the best bet, because if we go back several thousand years, well, we can get gold from then. It's still worth at least what gold is today, whereas all the companies back then, stocks, etc., those are now worthless. Paper currency is largely worthless. Gold remains. Other possibilities, the Chinese yuan, well, they're certainly growing. Their economy is growing over the United States, but it hasn't really been accepted that much as a currency outside their country. The IMF has a basket of special drawing receipts, which is a combination of multiple different countries' currencies. People could start adopting that as a replacement for the dollar and sort of go with an international standard. Or there's some somewhat more bizarre proposals, like in the future having carbon credits, and unless you buy a carbon credit, you can't actually basically do anything, burn any carbon, create anything, and you could use that as a sort of currency. So dollar's share of the world reserve currency went up drastically during the 90s, along with the dot-com bubble, a lot of people investing in the U.S., but has been decaying since then, down into the 60% range from the 72% range in the 2000s, and today it is back down to below 60%. So at least at the moment, the U.S. is in decline. It makes sense it can continue to decline. The U.S. government is not doing a very responsible act of preserving its currency, but neither are most of the other world governments. The special drawing receipt that's mentioned is sort of an effort to show a basket of what is used in the world. The dominant part of it is still the US dollar, but that's less than 50%, with about a third the euro, 12% British pound, and 7% Japanese yen. So far, I've discussed how government-created inflation tends to create economic crises. At least in the short run, not everybody believes this is true. The Keynesian economists, started by John Maynard Keynes, believe in things like stimulus packages and things like stock market bubbles are created by animal passions. There is some evidence for activities like this. For example, the 1600s tulip mania in the Netherlands, where you could buy multiple items for a single tulip, as we will see in the next slide. It is hard to tie that to monetary policy and seems to be just sort of equivalent to a stock market mania, not necessarily caused by money printing. Monetarists like Milton Friedman believe in things like the federal government doing quantitative easing, printing lots of money after an economic crisis to get the economy going again. And he got his Nobel Prize for the Great Deflation, advocating that the Great Depression could have been somewhat prevented by printing lots of money during the 1930s, rather than letting the money supply go down and the stock market and the cost of goods go down with it. I more fall in line with the Austrian economists, such as Ludwig von Mises and another Nobel laureate, Friedrich Hayek, who believe things like the Great Depression were caused not by the stock market dropping, but really by all the money printing in the 20s that caused it to go up so much in the first place, and then the bursting of the bubble at the end of that time period, 29 to 33, is largely inevitable when you have created malinvestment by money printing, whether that malinvestment goes into the stock market, like in the 1920s and the dot-com bubble, or into the housing market, like in the 2007 end of the housing bubble. So on to the Keynesian economics idea of animal passions. Here is the example of what a single tulip bulb called a viceroy, at least in theory, bought at one point, from an excellent book by Charles Mackay called Extraordinary Delusions and the Madness of Crowds. So for your viceroy, you could buy a lot of wheat, rye, oxen, swine, sheep, wine, beer, butter, cheese, bed, clothes, and a silver drinking cup. Monetary policy and economic crises have caused not only stock market bubbles, but also a lot of bank failures. There have been 3 different cycles of bank failures, one in the 30s associated with the Great Depression, one in the late 80s and early 90s, the Savings and Loan Fiasco, and again this set of bank failures during the bursting of the housing bubble. I have an article with the Foundation for Economic Education called Monetary Policy Disasters of the 20th Century that goes through each of these cycles in a good amount of detail. The 30s one was caused to some extent by speculation in the stock market. Back then, if you made a bank deposit, they just didn't make home loans or car loans with it. The bank could take it and invest in equities. This worked fine when the stock market went up. When the stock market started to drop, then not only would you lose your money in the market, but your bank could have put the money in the market and the bank itself could go bankrupt. And of course, a lot of this leverage, people only put 10% down. So you could borrow from the bank, put maybe 10,000 of your own dollars in the stock market and 90,000 of borrowed money in the stock market. 10% drop calls a margin call. People have to sell their stock and the market drops even more. And of course, not only just individuals were doing this, but banks were doing this. The resolution to this was called the Glass-Steagall Act, which separated commercial and investment banking. For example, split Morgan Guarantee into J.P. Morgan, which was a commercial bank and only dealt in loans, and Morgan Guarantee, which was an investment bank and only dealt in stocks. Glass-Steagall was pretty much eliminated in 1999 with the Congress and Bill Clinton. So this situation sort of exists again, but there are still some limits. The Savings and Loan Fiasco was a different situation, and it was caused largely by inflation. People were still making their loan payments, but if a bank owned a loan that paid only something like 3 or 4% and inflation was 10%, then they weren't making enough money back on the loan to actually pay their expenses. And we can go through in a little bit more detail what causes this. The final one, the housing bubble, was caused by people making mortgage loans on variable rates, and then the rates went up and they weren't able to make the payments anymore, and again defaulted. So other examples of how monetary policy causes crises, we can look at the stock market. This is the Dow Jones Industrial Average, and you can see gradual increase over time, but it tends to go in big spurts. This huge spurt here was the money printing during the 20s, causing the roaring 20s and the huge stock market increase, which then resulted in the Federal Reserve defaulting on the gold standard, and then of course you see a 90% drop in the stock market after the bubble bursts. During the 1970s, when the government was raising interest rates and actually fighting inflation, you made very little progress in the stock market. In fact, as the Fed funds rate was increased to fight inflation, the stock market dropped substantially. When the Fed funds rate was decreased, then it came right back up, and then dropped again, and then came right back up. And this continued throughout the 70s until the 82 recession, and inflation was gradually under control. Then you got another huge run-up in the stock market from 82 to 2000, as gradually the Fed decreased interest rates. And at the very end here, you can see the bursting again of the market at a 40% drop. This is a log scale with the bursting of the housing bubble, and of course before that the bursting of the dot-com bubble. So since the 50s, how the Fed controls the markets is through the Fed funds, or the overnight lending rate. This was not the philosophy of the Fed during the Great Depression. During the Great Depression, as Milton Friedman pointed out, they sort of kept the money supply as a constant ratio to the economy. So as the economy shrunk, they shrunk the money supply, which did cause the economy to further shrink, which probably did make the Great Depression last longer. But at the same time, not only did you have the stock market crash in the Great Depression, but you had FDR massively increasing tax rates to 90% on income taxes, and you also had a huge increase in import taxes, all of which caused the economy to stagnate, not to mention all of the interference in the business activity at that point in time that FDR engaged in. So since the 50s, the Federal Reserve has attempted to control the economy through the Fed funds rate. It doesn't appear they really know what they're doing. They increase interest rates, decrease interest rates, increase interest rates, decrease interest rates. The Keynesians would believe that this decrease in interest rates somehow gets the economy out of a recession. Others, like the Austrians, believe that interest rates should not be controlled by the government, but instead should be set by free markets and supply and demand for money. How this has caused problems can particularly be seen with the last graph and in the 70s. Here we have a time period after Nixon defaults on the gold standard, when the Fed is trying to fight inflation. They did this to some extent before he defaulted. That you see an increase of interest rates around 1970. Well, that caused the stock market to come down, but then they decreased the rates soon after that, caused the stock market to go up, increased them here, caused the stock market to go down, decreased them here, stock market goes up. Strangely, these sort of things tend to coincide with presidential elections when they want the stock market going up. For example, in the 72 presidential election, and again in the 76 presidential election. This was finally stopped by Paul Volcker, who Jimmy Carter appointed in '79, and he did not play politics with the interest rates. He instead increased them during the presidential election in '79, causing a recession and pretty much guaranteeing Jimmy Carter would not get reelected. Volcker told Carter and everybody else what he was going to do, so Carter was either altruistic or didn't understand the effect that monetary policy can have on elections. So Reagan got elected over Carter in 80, partly, I'm sure, due to the fact the economy was in a recession, partly to do with things like the Iranian hostage crisis. From 80 to 2000, you can see the Fed gradually decreased interest rates. But again, there's bumps up and down. So 80 to 2000, probably these decreases had a lot to do with the massive run-up of the stock market during that time period. But of course, there were ups and downs, and again, the increase finally here around 2000 probably helped burst the dot-com bubble, and particularly this increase from 2005 to 2007 was responsible for bursting the housing bubble, since that was directly tied to the interest rates that people got, the variable rates buying homes. Here we have more of a close-up of both inflation and interest rates from 63 to 2000, and we can use this to discuss things like the Savings and Loan Fiasco. So the Savings and Loan Fiasco was all the banks going bankrupt in the 80s and 90s. Well, if we look at a bank putting out a loan for 30 years around 1963, when inflation is 1%, they could have got a 4% fixed rate home loan. My father got one of these on a rental property, and that would give them a fixed rate loan up until the 90s. Now, in fighting inflation in the late 70s, Paul Volcker inverted the yield curve, so these banks that had a loan at 4% fixed rate 30, they later on had to finance that with maybe a 12% short-term loan. So they would be borrowing at 12 and lending at 4. That's a pretty easy way of losing money, which caused the savings and loan fiasco pretty much during this time period. Again, we can see that inflation kept popping up here. There were various attempts to eliminate this. When Richard Nixon defaulted on the gold standard in 71, you can see there is an inflation drop here. That's when Nixon put in price controls and made it illegal to raise prices or get a pay raise. This was done also in the US during World War II. People were patriotic during World War II, and it sort of worked. It did not work in the 70s, and Nixon quickly gave up on it with the exception of price controls on oil. This has been tried throughout human history. During the Middle Ages, the Catholic Church had something called the law of just price, where they tried to set the price of everything, all goods and services. It never works because, of course, markets change, and whenever you set a price below the market price, it just causes shortages. And of course, while Nixon got rid of most price controls, throughout the 70s, the government did set the price of oil, and by the late 70s, that did cause shortages in the United States in oil. Ford, when he took over, tried to do like a campaign against inflation, printed up win buttons for whip inflation now. Again, this really didn't work too good, and what finally got it under control was Paul Volcker increasing interest rates in 79, and then inflation becoming more stable. Here is a graph of oil prices from 47 to around 2012. Again, 72 here or so is when Nixon put in price controls. The red line is the US price of oil. The black line is the world price of oil. When you get a pretty big gap between them, as you did in the 70s, well, nobody in the world would sell the US oil. So there was plenty of oil in Europe and the Middle East, and this was during the time period that OPEC was pushing up oil prices, but no one would sell it to the United States because the world price of oil was in the 40s, the US price of oil was in the 20s. Why would you sell it here? And this, of course, did not make Texas oilmen or Oklahoma oilmen happy either. And there were gas lines in the United States, and gas stations ran out of gas, and people started trying to buy all the gas they could. Reagan did end this in the 80s, and of course oil prices continued to drop and we had relatively low oil prices. The best cure for high oil prices is probably high oil prices, makes people more efficient, and free markets do tend to be better than price controls. This doesn't mean that prices won't go up, particularly in oil, but the markets do tend to clear and correct a lot quicker than they would during a time period of government price controls. This is a graph of the inverted yield curve in 1980 when Paul Volcker pushed up short-term rates above long-term rates. And again, banks aren't real happy with this because then they borrow at a higher rate than they lend, which caused the Savings and Loan Fiasco. But the fact that the long-term rate, in this case the 30-year government bond, was down to 12, when the short-term government T-bill was at 15, was an indication that the markets did believe Paul Volcker would get inflation under control. And if you were smart enough to buy these 30-year government bonds at 12%, as my uncle, who was a smart businessman, would, then you would have got a 12% risk-free rate of return from 1980 to 2010, which is a very good risk-free rate of return. And again, this was a time period when the government was trying to fight inflation during the 70s and early 80s. Now the government doesn't seem to care and is basically claiming there is no inflation and printing money like crazy to finance its deficits, which will probably not end well. The value of a bond or home mortgage, which is designated by P, is the discounted sum of all future cash flows on that mortgage. C, the payment divided by 1 plus the interest rate in 1 year. If it has the same coupon payment the next year, like a fixed-rate home loan or a U.S. government bond, it would be the next coupon payment divided by 1 plus interest rate squared, etc., out to the life of the bond. Therefore, if interest rates go up, the value of a fixed-rate bond would go down. If we examine what happened during the housing crisis in 2007 and 2008, then we can go back to this graph and we can see that, well, the government increased interest rates from around 1% to 5%. This would cause that discounting to be significant, and that would cause the value of bonds to go down. That's certainly what happened in the Savings and Loan Fiasco. And this would hurt the banks with their long-term fixed-rate mortgages. But if they had clients with short-term mortgages or variable adjusted rate mortgages where each year the payment C goes up, then that's going to damage the mortgages in a different way. Consider someone with a $500,000 home loan, and if they had a 1% payment on that, that's $416 a month. Well, if short-term interest rates were raised, as they were significantly by the Fed funds rate, to 5%, then that monthly payment on their home mortgage would go from around $400 to over $2,000. So what happened in the housing crisis is there was a double whammy hit to banks with the increase in interest rates, and many people defaulted on these payments, not only just the questionable loans, the basically junk loans, but even some of the intermediate grade loans, and people simply weren't able to make these payments on their home loans, so there were huge amounts of defaults and banks had to foreclose on tons of people, therefore causing the housing crisis of 2007-2008. Well, today we are probably in another bubble. One of the ways of seeing this is looking at the Shiller price-to-earnings ratio. So this would be the price you pay for an average stock in the S&P 500 divided by their earnings, or the inverse of this is basically the rate of return you would expect, the earnings over price, sort of like a bank account. And this is up to approaching 40 today, 39. It's only been higher once during the dot-com bubble. It is even higher now than it was at the top of the bubble that then burst and caused the Great Depression. So it seems likely at some point the stock market is going to crash back down in the future, and as always in the past, this bubble has been created by government money printing. So how does one invest in this environment? How does one try and make money, or at least prevent themselves from losing money? Well, During stock market bubbles and during high inflation, stocks can do well. In a sense, you just have to know when to get out. Even during the massive inflation in the Weimar Republic, we can see here that the stock market went up, and it even went up in dollar terms. So you can make money in the stock market during inflationary time periods. Usually these bubbles tend to burst and tend to go back down later on. The US, again, we had a housing crisis after the 2006 bubble burst. Well, now if we look at the Case-Shiller price index, well, it's gone way back up even above that. So not only do we probably have a bubble in the stock market, we also have a bubble in housing. But not everything is completely in bubble territory. If we look to the Dow to gold ratio, well, it's not up to the point it was during the dot-com bubble, so gold has gone up somewhat with the Dow. Hard to say which is the better investment right now, the Dow Jones Industrial Average or gold. I'd probably be inclined to say gold. If you look of real estate to gold, then by this measurement, real estate doesn't look too bad. So both have gone up together. Real estate certainly isn't as bad as the stock market. And the US has skyrocketed, or at least its stock market has, but the rest of the world hasn't nearly as much. Here we have the MSCI USA over MSCI World, and you can see that the US is relative to the rest of the world at an all-time high, well above where it was at the peak of the dot-com bubble or during any other time period. So if you are investing today, Europe, Asia, and particularly emerging markets may be a better place to put your money than the United States. There's also a distinction in the US between so-called value and growth stocks. Growth stocks being dot-com tile stocks, particularly the tech industry stocks at this point in time. Value stocks would be things like banks, oil companies, stocks that really haven't taken off and have relatively low P/E ratios. And we can see that the ratio of growth to value stocks has only been higher once, again during the dot-com bubble, and that time period lasted for only 14 months. Well, we are now about 12 months into the growth value bubble. It is still around this 1.3 time period. I haven't updated this graph, but things haven't changed much between March and August. So right now could very well be a good time period to be in value stocks and not growth stocks. I wrote a paper on this for Seeking Alpha, and we'll do another video on it. Examples of good value funds to potentially be in would be with Vanguard Mutual Funds, VTV, VOE, VBR, or a high dividend fund, VYM, whereas the growth stocks would be things like in the QQQ or even the S&P 500 today, since it has very little growth stocks, at least in its top 10, largely just Berkshire Hathaway and maybe JP Morgan. If we look at the relative size of world stock markets over time, we can see that the US has skyrocketed from 15% 100 and some years ago to over 53% today. But another indication of how the US could be overvalued, well, it's 53% of the world's markets by market cap, but the US is only around 25% by GDP. Reasons for this are A, the market is overvalued, but B, also a lot of other countries have not monetized nearly as much of their assets as the US has. So if we look at world GDP, the US is only 24%. So probably you want to diversify outside the United States, and I would say in the US invest in value stocks. Internationally, maybe put at least half of your money outside the United States. International investments like this can do a very good job of diversifying risk. Here we see risk as a percent measured by a standard deviation of investments, and the number of stocks. Well, as you add more and more stocks, of course, the risk goes down. A mutual fund or an index fund is less risky than an individual stock, but if it's all in one country, that still concentrates the risk. Here we have a 25% standard deviation of the US stock market. If you invest in a global portfolio, at least according to this graph, you can measure or lower that risk to maybe around a 10% annual standard deviation. Ways of doing this would be, again, Vanguard Fund's WT for their Total World Market Fund, Total International Fund, WXUS Europe, VKG, Asia VPL, emerging markets, which are valued right now even lower than most international funds and are probably a good investment, VWO, and also an international high dividend fund, VYMI. There are lots of good locations for further reading on these topics. I have articles personally with the American Institute for Economic Research, with the Foundation for Economic Education, and at Seeking Alpha, as well as my other pieces on the YouTube channel. I've also covered topics like McKay's Extraordinary Delusions and the Madness of Crowds, and a lot of my graphs came from an excellent site called longtermtrends.net. I thank you for watching this video.